What if I told you that gold, the undisputed ultimate safe haven asset for the last century, just crashed nearly 30%?
Yeah, it's a massive drop.
Right. And the crazy part is some of the smartest institutional money in the world is just, well, completely unfazed by it. I mean, while traditional markets are sweating out geopolitical rumors and all this shaky macroeconomics, those same institutions are quietly accumulating tens of billions of dollars in digital assets.
It's really a phenomenal misdirection if you look closely. I mean, the headlines are screaming about chaos and recession risks, right? Which pulls everyone's attention to the short-term volatility.
Exactly.
Meanwhile, the heavy capital, they're taking advantage of that exact panic to secure massive positions in the underlying infrastructure of basically the next financial system.
Welcome to today's deep dive. We have an incredibly dense stack of sources to go through with you today.
We really do.
And our mission here is to unpack this intense, high-stakes tug-of-war happening right now. It's between the marble pillars of traditional finance and the decentralized frontier of crypto.
Which is moving incredibly fast.
It is. So we're pulling intelligence from institutional newsletters like the Crypto Pulse. We're dissecting a pivotal annual letter from the world's largest asset manager and synthesizing analysis from top voices, like Coin Bureau and Benjamin Cowen.
Yeah, because we're looking at a market undergoing a fundamental rewiring right now. To understand who is winning this tug-of-war, we really have to look past the daily price action. We have to examine the structural moves being made by global banks, corporate treasuries, and, decentralized protocols.
Okay, let's unpack this. Because before we can track where all the money is quietly flowing, we have to examine the shaky macroeconomic ground that's causing these massive shifts.
Right. The foundation itself.
Exactly. And the current environment for you as an investor is just saturated with noise. Take the market whiplash from just yesterday, for example.
Oh, yeah, that was wild.
The crypto market caught this sudden, aggressive bounce based on rumors that Donald Trump and Iranian officials were having active discussions about de-escalation.
And you see, markets algorithmically crave stability.
Right.
So the mere whisper of geopolitical de-escalation, it triggers automated buying across the board, just instantly.
Just bots reacting to headlines.
Exactly. But we have to look at how quickly that narrative fractured. I mean, impartially speaking, Iran's parliament speaker came out shortly after and categorically denied that any negotiations took place.
Completely shut it down.
Right. They called it a fabricated rumor designed specifically to manipulate global markets.
So the market essentially got spooked by its own shadow. I mean, traders who bought that bounce are now sitting on their hands, right?
Yeah, wondering if they just provided exit liquidity for a manufactured narrative.
Exactly. And it completely shifted the psychology overnight, from optimism back to extreme caution.
And that caution is really compounded by a macroeconomic foundation that is showing real stress fractures right now.
Which brings us to Benjamin Cowen's latest analysis.
Right. He points to the canary in the coal mine, which is gold. As you mentioned, gold recently dropped nearly 30% here in 2026.
Which is wild.
It is. For an asset whose entire brand identity is wealth preservation, a 30% haircut in a single year catches everyone's attention.
But wait, why would gold drop right when the labor market is weakening and things are starting to look structurally bad? I mean, shouldn't a safe haven asset do the exact opposite when recession risks spike?
Well, what's fascinating here is that this drop is actually a feature of a late-stage business cycle.
Right.
It's not a bug.
Really? A feature?
Yeah. Cowen draws direct parallels to the markets in 1973 and 2008.
Okay.
In those periods, stocks began to break down against gold, but gold itself took a sharp initial dive before eventually recovering to make new highs.
Why does it take that initial dive, though?
The mechanism behind it is a pure liquidity squeeze.
Okay, walk me through that.
When traditional equities panic and drop sharply, these massive institutional investors get hit with margin calls.
Oh, so they need cash immediately.
Exactly. They suddenly need billions in cash to cover their leveraged positions. And you don't sell your toxic illiquid assets in a panic. You can't. You sell your most pristine liquid assets. You sell gold.
Wow. So you liquidate the good stuff just to plug the massive holes left by the bad stuff.
Precisely that. It's a desperate grab for liquidity, not a fundamental rejection of gold's value.
That makes so much sense.
And Cowen notes that this exact same liquidity drain is what's dragging down Bitcoin and altcoins in the short term. The macro environment is shaky, so everything is being sold to raise cash.
So it feels like we're watching a magician, right? That macro chaos and fake news, that's the flashy misdirection in the left hand.
That's a great way to look at it.
While the real trick in the right hand is the quiet, methodical accumulation by these corporate whales.
Right, because they are entirely focused on long-term supply dynamics. The day-to-day volatility is just background noise to them.
I want to push back on that slightly, though, because if you look at MicroStrategy's recent activity, which was highlighted in the Crypto Pulse, they dropped their weekly Bitcoin buying from $1.5 billion down to just $76.6 million this past week.
That's a big drop.
It's an absolute cliff dive in purchasing volume. I mean, to me, is that massive hesitation? Are they finally getting spooked by this late cycle macro weakness?
It definitely looks like hesitation on the surface, I'll give you that. But the underlying market mechanics suggest it's highly calculated pacing.
Calculated how?
Well, when an entity is deploying billions of dollars into an asset with a fixed supply cap, like Bitcoin, they cannot just market buy all at once.
Right, they'd break the market.
Exactly. If they did, they would instantly spike the order book and ruin their own average purchase price. So they use time-weighted average price algorithms.
QAP strategies.
Right, 2-act strategies. They use them to absorb the available supply quietly. So they throttle down when liquidity dries up, and they throttle up when sellers enter the market.
Okay, so they're just pacing themselves so they don't accidentally engineer their own price squeeze.
Exactly.
That makes sense. But if we want to talk about raw, unhesitating accumulation, the data on Ethereum is just on another level entirely.
Oh, it's staggering.
BitMine is executing a treasury strategy that is almost difficult to comprehend. They just purchased another 65,341 ETH.
And that single purchase is massive on its own, but it's the cumulative total that really alters the landscape here.
Yeah, that brings BitMine's treasury to 4.66 million ETH.
Which in dollar terms right now is roughly $10 billion.
They now control 3.86% of the entire global supply of Ethereum. I mean, one company holding nearly 4% of the network.
It's unprecedented.
But the brilliance of this play isn't just hoarding a scarce asset in a cold wallet. They have over 3.1 million of that ETH actively staked on the network.
Right, because Ethereum operates on a proof-of-stake consensus mechanism.
Right.
By locking up their ETH, BitMine is actively processing transactions and securing the network itself.
And getting paid for it.
Exactly. In return, the protocol programmatically pays them a yield derived from network transaction fees and new issuance.
It's like digital real estate that pays continuous rent. And the math on that rent is just staggering. That staked position is generating roughly $272 million in annual rewards.
Over $250 million a year.
In passive programmatic income just for securing their own holdings. Tom Lee recently analyzed this and concluded that Ethereum is in the final phase of a, quote, mini crypto winter.
Yeah, I saw that.
He noted that it's actually starting to act as a hedge during these global conflicts.
And the cash flow dynamics of staked Ethereum completely change how corporate treasuries view the asset.
How so?
It transforms it from a pure speculative commodity into a yield-bearing instrument, which is exactly why the legacy financial system is paying such close attention to it now.
Here's where it gets really interesting. This isn't just Wall Street buying Bitcoin to hold on their balance sheets.
No, not at all.
This is them wanting to rewire the entire financial house so the plumbing runs on blockchain. They don't just want the asset, they want the underlying technology.
If we connect this to the bigger picture, we really have to analyze Larry Fink's latest annual letter.
Right, the CEO of BlackRock.
Exactly.
Meh.
Managing over $11 trillion, his letters essentially dictate the strategic direction of global capital.
And this year, his entire thesis rests on one concept, right? Tokenization.
Tokenization.
Which sounds like a buzzword, I know, but the mechanical reality of it is revolutionary. Fink points out that half the world's population already operates digital wallets.
Think about it. You use Apple Pay, you use Venmo or Cash App.
Right. You, the listener, are completely conditioned to send digital value instantly.
And Fink's argument is very simple. Why can't that exact same digital wallet execute global investments just as seamlessly?
Because right now, the friction in traditional markets is awful. I mean, if you want to buy a share of the S&P 500, you route money to a brokerage, wait for the funds to clear.
Which takes days.
Buy a whole share during highly restricted market hours, and then wait another 2 days for the clearinghouse to actually settle the trade.
It's incredibly slow.
Okay.
But tokenization takes that traditional database entry, whether it's an equity, a treasury bond, or even commercial real estate, and issues a cryptographic token representing it on a blockchain.
And the moment that asset becomes a token on a distributed ledger, all those legacy bottlenecks just vanish.
Easily. The tokens can be mathematically fractionalized down to the 8th decimal place.
Oh.
They trade 24 hours a day, 7 days a week. And instead of taking 2 business days to settle, the trade and the settlement happen simultaneously in seconds.
Fink explicitly compared this technological leap to the transition from physical postal mail to email.
It really is a fundamental upgrade to capital efficiency.
Right.
Last year, Fink focused on validating the technology. This year, he's focused on distribution.
Right, reaching the unbanked.
Exactly. He's looking at billions of unbanked or underbanked individuals who have smartphones but lack access to global liquidity. Tokenization democratizes that access.
Think about how you invest right now. What if it was as easy as splitting a dinner bill? Imagine buying a fraction of a commercial high-rise in Manhattan on your phone.
And the regulatory red tape that usually blocks this kind of innovation is actually being cleared away right now.
Yeah, under the new SEC chair, Paul Atkins, this is moving rapidly from just white paper theory to actual binding rulemaking.
The SEC just greenlit NASDAQ's pilot program to actively test trading tokenized shares.
And NASDAQ didn't stop there, did they?
No, they partnered with Telos, a digital asset firm, to allow institutional investors to use tokenized assets as collateral.
Which is a huge deal.
It's crucial because instant settlement completely removes counterparty risk. You don't have to trust that the other institution is good for the money 2 days from now.
Right, because the smart contract verifies the collateral and executes the swap instantly.
Exactly. And the dominoes are falling globally. Goldman Sachs explicitly name-dropped crypto in a shareholder letter for the first time in their history.
And down in Australia, Host Plus, which is a massive pension fund, they're exploring how to pipe crypto access directly into self-directed retirement accounts.
Global finance has stopped asking if blockchain is the future settlement layer.
They know it is.
They are now solely focused on how fast they can dominate it. Because tokenization is traditional finance's attempt to democratize access while maintaining their central role. They absolutely intend to remain the toll booth operators of this new system.
Oh, but there is a massive civil war brewing within traditional finance over this.
Oh, absolutely.
Asset managers like BlackRock love the efficiency of tokenization, but traditional commercial banks are absolutely terrified of it.
Terrified.
Specifically, they're terrified of the yield it generates.
To understand that fear, you really have to break down the traditional banking profit engine. Coin Bureau highlighted this brilliantly.
Yeah, break that down for us.
The legacy banking system survives on net interest margin. You deposit your paycheck, and the bank pays you an interest rate of roughly, 0.4%?
If you're lucky.
Right. And then they turn around and lend your deposits out for mortgages or invest them in treasury bills, yielding 3 to 5%.
So they just pocket that massive spread. It's an incredible, practically risk-free arbitrage that funds their massive skyscrapers and thousands of employees.
And stablecoins completely shatter that model.
Because a stablecoin is a digital token pegged to the US dollar.
Right. But because it operates on a blockchain through decentralized finance protocols, there is no brick and mortar overhead.
No skyscraper to pay for.
Exactly. There are no thousands of employees to pay.
Right.
So when that stablecoin generates yield, the smart contract passes 4 to 7% directly back to the user.
Wow. So it effectively cuts the commercial bank entirely out of the loop.
Entirely.
And when a trillion-dollar industry faces an existential threat that can mathematically outcompete them, they don't try to innovate, do they?
No, they call their lobbyists.
They call their lobbyists. And we have to look impartially at the legislative warfare happening here. Congress previously passed the Genius Act, which explicitly bans stablecoin issuers from paying yield directly to customers.
Right. But decentralized finance is built on composability and open source code.
So they found a loophole.
Exactly. When the U.S. banned issuers from paying yield, the market simply routed around the block. Offshore protocols took those zero-yield stablecoins, lent them out to borrowers, and issued wrapped receipt tokens back to the users.
And those wrap tokens continuously accrued the interest.
Yes. They utilized third-party smart contracts to deliver the yield without the U.S. issuer technically paying it.
Clever. So now the banks are escalating. They are pushing incredibly hard for the Clarity Act, specifically Section 404.
Which is a huge piece of legislation.
This aims to blanket ban all stablecoin yield for U.S. citizens, regardless of whether it's wrapped, routed through a third party, or generated offshore.
And they cite consumer protection and the risk of massive capital flight from the banking system as the public reasoning.
But the structural reality is that Section 404 is a protective moat designed to preserve their 0.4% net interest margin. But if banks successfully lobby to ban this yield, won't that just backfire?
How do you mean?
Capital is ruthlessly pragmatic. It goes where it is treated best. Money isn't going to just sit quietly in a Chase savings account earning 0.4% if it mathematically knows a 7% yield exists just one click away.
Right.
Won't a ban just force all of that money entirely out of the traditional system and U.S. regulatory perimeter?
This raises an important question about the limits of jurisdictional law on borderless technology. As Coin Bureau concluded, you cannot easily legislate away a global smart contract.
It's just code on the internet.
Exactly. If the U.S. bans stablecoin yield, the capital will simply flee. It'll migrate to decentralized lending protocols like Aave, or it'll move to offshore platforms that operate completely outside the reach of U.S. courts.
So by trying to build a regulatory wall to trap the capital inside the legacy system, they're actually incentivizing a mass exodus.
A ban might actually accelerate the shift away from traditional banking rather than protecting it.
Wow.
And that brings us to the most critical part of this analysis. If that capital flees the heavily regulated FDIC-insured banking system and jumps into decentralized finance, what exactly is it jumping into?
So what does this all mean? It's like moving your money from a heavily policed, low-interest bank to the Wild West.
That's a very accurate analogy.
It's a frontier that offers explosive, unprecedented growth, but carries extreme, sometimes devastating technological risk. Let's look at the growth side first.
The demand for decentralized access is going parabolic right now. Look at Hyperliquid's HIP-3 tokenized market.
Right. They just crossed $1.74 billion in open interest, meaning there's $1.74 billion worth of active, unsettled derivative contracts currently sitting on their platform.
And the catalyst for that volume is the massive demand for trading real-world commodities.
Like tokenized oil and silver.
Exactly. Traditional commodity markets close on the weekends, but geopolitical conflicts and supply chain disruptions don't care what day it is.
Right. News breaks on a Sunday.
And capital is flocking to DeFi because it allows them to hedge oil risk at 3 a.m. on a Sunday.
But that explosive, permissionless growth is running headfirst into regulatory crackdowns.
It is.
U.S. lawmakers are actively pushing restrictions on sports and event-based prediction markets. Platforms like Kalshi and Polymarket are being forced to tighten their insider trading controls to appease regulators.
Regulators are very uncomfortable with these decentralized, crowdsourced truth engines.
Right. But regulatory friction is a constant. The true existential threat in this frontier is the dark side of DeFi. It's the code itself.
This is where your Wild West analogy gets very real. A smart contract is basically an unbreakable digital vending machine.
Right.
You put your stablecoin in, and the code executes automatically to pay you that 7% yield. It is beautifully efficient.
Until it isn't.
Right. If a hacker figures out a mathematical flaw to reach up inside the machine and release all the funds, there is no bank manager to hit an emergency stop button.
Yes, you can trade oil at 3 a.m. and earn 7%, but as we saw with Balancer Labs, the bank vault can also get blown wide open.
We saw this exact nightmare scenario play out. Balancer was a foundational protocol in the decentralized finance space, managing massive liquidity pools.
And what happened?
A hacker found a critical vulnerability in the complex math the smart contract used to calculate pool balances during a flash loan.
Just for context, a flash loan is where you borrow millions of dollars of crypto for just a few seconds, unbacked, as long as you return it in the exact same transaction block.
Right. So the hacker used a flash loan to temporarily skew the protocol's price oracles. This tricked the smart contract into executing trades at drastically manipulated prices.
Oh, wow.
By the time the block was validated, $128 million had been completely drained from the protocol.
Just vaporized in seconds. $128 million. And because of that exploit, Balancer's core corporate entity is now entirely shutting down.
Yeah, they had to abandon the traditional corporate model.
They're shifting to a DAO, right? A decentralized autonomous organization, meaning the protocol will now just be governed by community token holders voting on code updates.
Stripping away all centralized overhead just to survive.
It's stark.
It really perfectly synthesizes the dichotomy investors face today. In traditional finance, if a bank gets robbed or mismanages funds, you have a safety net. You have FDIC insurance. The government steps in to make depositors whole.
But in DeFi,
in decentralized finance, the code is absolute law. It provides incredible capital efficiency and yields that banks refuse to match. But if the code has a flaw, the finality of the blockchain means your money is permanently gone.
The current iteration of DeFi sorely lacks that safety net. It's a massive paradigm shift, and the stakes couldn't be higher.
Absolutely.
So, to quickly recap the journey we've taken today, we started by cutting through the flashy misdirection of macroeconomic fake news to see corporate whales quietly accumulating billions in Ethereum.
Recognizing its power as a yield-bearing asset.
Right. Then we explored Larry Fink and Wall Street's grand vision for tokenization, aiming to turn your smartphone wallet into a 247 fractional investment terminal.
Which is huge.
We analyzed the fierce lobbying by traditional banks pushing the Clarity Act to kill stablecoin yields and protect their profit margins. And finally, we looked at the volatile, high-stakes reality of decentralized finance, where you can earn that high yield, but a single logic flaw can cost you everything.
It really leaves us at a fascinating crossroads in financial history. I mean, think about this. If Wall Street successfully tokenizes traditional assets on the blockchain, while at the same time regulators push actual crypto yield offshore into the Wild West of DeFi, are we heading toward two completely parallel, isolated financial systems?
That is a wild thought.
And if so, as the technology matures, which one will eventually swallow the other?
That is the trillion-dollar question. Does the legacy system absorb the blockchain, or does the blockchain replace the legacy system? You have to keep your eyes open and make sure you aren't getting distracted by the flashy smoke in the magician's left hand, while the real future is being built quietly in the right. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking past the noise, and we will see you next time.